Yeah, hello. We start from chapter 6, which is about the analyzing operating activity. Before getting into this chapter, I want to show you the structure of this chapter and what it's about. So all these topics are relevant with the operating activities. That's why it's important to know them and then how to analyze them. So we start our lecture by income measurements, and then non-recurring items, revenue recognitions, actually how to analyze it, deferred charges, employee benefits, and interest and tax. So these are the topics that would be covered in this chapter. So as we know, the bottom line of all operating activities for a company, for a business, will be measured by the income. In order to know that the company is doing well and the operations of the company are healthy and good, or also to know that the company is growing, or any other criteria for the performance of the company refers to the income. Okay, so how incomes would be measured, and it's important to know what's supposed to be included in income and what's supposed to do to be not included in the income. Sometimes some of the firms are including some items which is not supposed to be in the income statement. They want to show the income of the company to be attractive for the investors and creditors. But in reality, it's not that much. It's not that much big, the income. So there are some measurements of income. There are some concepts of income. Okay. First of all, economic income. So what does economic income includes? It includes all the change in the investor's equity in the company during a specific period of time. Okay, so it includes net cash flows and the change on the present value of the future cash flows, and it includes both recurring and non-recurring components. But this is actually not reflecting the actual operation income for the company. Why? Because whenever we talk about the operating income, it should be including the recurring activities. It means like they should include those activities that are repeating over time, such as sales of the production. Okay, let me write some extra. I'm gonna open this extra sheet over here. We use it as such as the okay, and I can get this smaller. Okay, so recurring and non-recurring activities. This is such as, let's say, sales, okay, receivables. But also in terms of expense, this can include, let me write them in one line, salaries and office expenses, okay. But non-recurring activities, like you are earning some good cash, some good money, but not from the operating activities. For example, you have a land, the company sells a piece of land for a huge profit. Okay, like let's have the Pepsi company as an example. So Pepsi, we know Pepsi are producing beverages and selling beverages, and that's the only source of income of the company. Okay, but besides, once a time they have extra cash and they bought some properties, some lands, and after 2 years they are selling that land for a huge profit. So this once a time. I mean, this will not happen every year, so that should not be included in the income actually. But in terms of economic income over here, it has been included. Okay, any cash inflows will be included in the income, and year over year we see this economic income as reflecting the change in the investors' equity. So another type of income is permanent income. So this reflecting like how will be the income for the company forever. That's a kind of earning power of the company. Okay, so through this you can expect some upcoming years income for the company, and shows the earning power of the company over how many years will be, like using the past earnings, past incomes. We can expect the future incomes of the company. Okay, that's another type of income. And the most important is the accounting income. Okay, so the accounting income consists of permanent components and recurring components expected to persist indefinitely, and transitory components of the company and value of irrelevant of the company. In order to not get confused, this type of income, okay, in brief, is based on the accrual accounting. It's determined by recognizing revenue and expenses. Okay, so expenses and revenues of the company. Okay, whenever we talk about non-recurring over here, this is any gain from this non-recurring activity called gains. Okay, and any expenses from these non-recurring activities called losses. We are not calling this revenue and this loss. Okay, any decrease in the equity or decrease any cash outflows over here calls losses, not expenses. So accounting income includes only recurring accounting. Whenever we talk about recurring, we have here expenses and revenues. Okay, so that's the accounting income, which consists of that. Okay, so now we understand that whenever we talk about income, we go for expenses or losses and revenues or gains. Okay, so the aim of operating activity is to differentiate between expenses and losses and revenue and gains. So we should recognize, when we check the financial statement of a company, we should recognize which one is gain and which one is revenue. And whenever we look at the company's income statements, we should expect to not see this one. Okay, in the income statement, this can be mentioned in the financial statement somewhere else, but not in the income. This is not an indicator for income of the company, because it's happening only once and it's not repeating. It's not from the operation activities. Okay, the same is for the expenses. If the company lost because of an earthquake, a financial crisis, a pandemic like coronavirus, so this should not be recognized as expense. Okay, so here are the two main components of accounting income: revenues, gains, and expense or losses. Okay, so what does these telling us? These are telling us revenues are expected to repeat in the future, and these are the source of in-cash flows from the operations. Sorry for that. But we have also gains, which are not recurring. Okay, which are not recurring. The same for expenses, which are incurred outflows, prospective outflows. Okay, those are expected to recur, but losses are not. So the aim of an analyst is to differentiate between those. Okay, why? Because companies are showing these gains as a revenue of the company, but it's not. Okay, so when we understand the difference between expense and losses, revenues and gains, so we know which one is from the operating activities and which one is from the non-operating activities. Okay, so Here are some alternative income measurements over here. So it's a net income. Whenever we talk about net income, we mean the operating income over here. Okay, so I would add operating income. It means we are including revenues and expenses, not losses and gains over here. Only recurring components, okay, activities. So comprehensive income includes most changes to the equity results from non-owners sources. This comprehensive income actually is equivalent to economic income. We've been through it in the previous slides. So those are mentioning the net change in the equity of the shareholders. Okay. We have also continuing income, which is equivalent to, let me show you here, permanent income, okay, earning power of the company. And this excludes extraordinary items. We will learn what are the extraordinary items over here, okay. So the analysts, very important to differentiate between operating and non-operating incomes. Okay, so and these are particularly important for financing and investing activities. Okay, when the company goes to borrow money from a bank or issues a bond to the financial market, people are looking at the income statement of this company, how they are doing well. So they are not expecting to see non-operating incomes in the income statement, net income. Okay, and the same of investing. I'm an investor, for example. I want to invest my money to buy the stocks of this company, but the problem is whether I can expect expect the share price to go up in the future or not based on the net income. Okay, so how's the net income of this company? So now we talked about recurring items. Now we are talking about non-recurring items, what to be included and what are the examples of those. So we said like extraordinary items. This is like 2008 financial crisis, earthquakes in Japan, and coronavirus, actually the pandemic now. Okay, so discontinued operations or segments. For example, I'm gonna give you an example for this. Okay, discontinued operations. Again, sorry about that. Discontinued segments or operations, it's the same. Like for example, Pepsi company are selling beverages and also producing, let's say, mobile phones. Okay, This is partial job of the company, this one. So this is a partial job of the company. So they may be doing it for a few years, but suddenly they decide to stop this production, and this incurs a very huge loss to the company. So this is a kind of non-recurring items, okay? So when the investor or the creditors analyzing the financial statement of Pepsi, so they are going to see or to investigate the selling of beverage, the market proportions, the market of beverage, and the share of the Pepsi in the market in the beverage industry, not the other types. Okay? An accounting change is a kind of like, for example, a company uses GAAP, but suddenly they are shifting to IRFS system of the accounting, and it happens once. I mean, it happens only once a time, not every time, not every year, not every month, and the rest are more or less the same. So we understand what are the recurrent items over here. Okay, and these slides are talking about that in detail, and we will have problems and exercises practicing on these concepts. Okay, so these are the special items. Transactions and events are unusual or infrequent, so all comes to the same. Okay, so analyzing the special items over here. For example, earning management with special charges. Special charges often garner less investor attention under an assumption they are not recurring and not persist. Okay, so these special charges, these special, let's say, cash inflows are not attracting investors, as I said. So coming back to this event, okay, or let's say Pepsi company invests, invests in Microsoft stocks, and return is, let's say, 30%. It's a huge number, but is there a guarantee that every year this repeats? No. And next year can be negative 30%, which should be considered as a loss, not revenue or not expense. Okay. Managers motivated to reclassify operating charge as special one-time charges. So more or less we are talking about the returns or the revenues, the gains. What about the losses? What about the losses? The problem is, let's say, Pepsi company loses 25% of sales, which is equivalent to 20% decrease in net income. Now, the accounting department of the company may go and deduct this loss, decrease in sale, okay? This losses. This decrease in sale as a losses, not an extra expense. In order to have a clear, another example is like, anyway, considering these expenses as a losses, okay, like raw material. So raw material prices increases results in increase of expense by, let's say, 35%. So they try their best, the company, to show this expense as loss, and they to tell public and investors and other guys who are concerned, stakeholders anyway, that this expense, this extra expense is loss. It means that will not repeat in the future. That was only one time, but it is expense. Okay, so we should be careful to recognize expenses and losses and revenue and gains again. Okay, so that was the second point about. Another thing is, when analysis ignore such reclassified charts, it leads to low operating expense estimates and overestimates of the company's values. So when expense decreases, income increase, this consequently affects the market value of the company to increase. Okay, so the market value will be overestimated. It means, like, if we see, for example, stock price is 10%, let's say $55, its actual price is only $40, and this has been because of recognizing some expenses as a loss, and net income increases and their market value have been overestimated. Okay, so let's start with the revenue recognitions. We have covered this revenue recognition, I remember, in the intermediate class, in intermediate accounting 1 class. Okay, but what's important to know here, revenues are repeating, like it's from the operation activities of the company, not only once. So here are some guidelines and criteria to recognize revenues over here. So for example, revenue recognize normal yield, an increase in cash, receivables, or securities. Okay, so recognizing revenue increases cash, receivables, and revenue. Okay, so let's move to the next slide and some other stuff. For example, franchise revenue. McDonald's company gives a franchise right to thousands of investors. They are opening the store using the McDonald's company. So the franchise charge will be like based on the sale of this specific store. Thousands of them and dozens of thousands of them will be collected as a franchise revenue of the company. So completion and completion methods, and also we have unearned revenue, amount of revenue that are still unrecognized, appear in the balance sheet as a liability. So here is we provide the service, but we will get the paid in the future. So should be careful about those. Okay, revenues, analyzing revenues of the company, 2 points are very, very important. Okay, assessing the risk of transactions and assess the risk of collectibility. Whenever we have a big receivable account, how much from this we're gonna collect? The company is able to collect. Is it expected to be collected as it's scheduled or not? Those are given informations about the company actually, and very important. So another category of this chapter which should be covered over here is deferred charges. Okay, costs incurred but deferred because they are expected to benefit future periods. So those are 4 of them. What are these deferred costs? I would say like research and development. So we understand better from these. Every year, huge amount of the big companies, like huge amount of money, the big companies are spending on R&D, research and development. Why they do it? Because they want to invent or innovate something in order to survive in the market and compete the other strong companies. So imagine, for example, Samsung company versus Apple company versus nowadays Huawei company. Okay, I don't know whether this spelling is right, but no. Okay, anyway, Huawei company. So these guys are working and paying money, spending on research and developments. But the thing is, whether this research and development can find something which benefits the company, brings money, extra profit, extra earning to the company in the future or not. It's a kind of not sure. Okay, it's a kind of not sure, but still the companies are doing that. Yep. So another thing is computer and softwares. So these guys, these companies are bringing in some new softwares or new computers, new technologies to the company, hoping that this benefits the operations. But are they doing that? Not sure, actually. Okay, and we have also costs in the extractive industry, which is like the companies like ExxonMobil, they come and make a contract with Kurdistan government to dig a rig to extract oil, and Kurdistan government, for example, gives them the area of how many kilometers square anyway, and they are telling that, okay, go there and look for oil. If you find it, extract it. 25% of this extraction will be yours. But the cost of looking for oil at that area is huge, and they're not sure. Okay, that's what happened to the Russian company in the Sharazur area, and also the South Korean companies in Kurdistan. They got some areas, they looked, spent a lot of money and time and energy hoping that they are finding oils, but they find no oil over there. So all the cost is gone. Okay, so what about these actually? For example, accounting of research and development is problematic. Why? Because of high uncertainty of any potential benefits. That's what we said. Time period between R&D activity and determination of success. Okay, let's say we came out with some results in our research. When we can apply it and get some money out of it? Not sure. Time period is not sure. Intangible nature of most R&D activities. So spending money on R&D is not like spending money to buy a vehicle, to buy a land for the company. These are intangibles. This can go away anytime. Okay? Difficulty in estimating future periods, the same stuff. Hence, US accounting require expense in R&D when incurred. Okay? On a yearly basis. We are not waiting for the research and development outcomes. What we are waiting for is, what we are looking for, whenever we spend any money, the company spends any money on this process, it should be registered. It should be recorded. Okay? So only costs of materials, equipments, and facilities with alternative future uses are capitalized as tangible assets. Okay, so any equipment, laboratory, for example, computers, whatever they are using, so those goes under the category of tangible assets. Okay, so these are not expense anyway. Intangible purchased from other for R&D activity with alternative future uses are capitalized as well. Okay, so these accounting problems are too similar to those encountered with the employee training programs and product promotions and advertising. So these research and development activities costs are like, for example, you send your staff to Europe to get a training course, but you don't know whether they benefit from it and later on they benefit your company. Okay, and promotion products, for example, you make a promotion to sell your products, buy 2 and get 1 free, and you are not sure how much you benefit out of it. Also advertising, you pay a huge amount of money to the televisions to advertise for you, but you don't know whether you are benefiting or not from this. Okay. Computer and software and extractive industries such as oil, which we talked about, are more or less the same as the rest of deferred charges. Okay, and then employee benefits. Okay, so here are some let's say costs and expenses on the company, but the occurrence time is not sure, so those will be recorded when they occur. Okay, so how we do that, and what are the examples? These are the deferred compensation contracts, stock appreciation rights, junior stock plans, compensated absences, employee stock options. Okay, we stick on this to understand the rest as it's given by the book. Okay, as it is recommended by the book anyway. So what's the employee stock options, ESOs? Okay, so don't get confused over here. It is a kind of incentive to the CEO, to the manager of the company. So the board of directors are telling, like, to the CEO, for example. Okay, I'm talking here about ESOs, employee stock options. What are they? CEO, let's say current stock price is $55. CEO has a right to own 1,000 shares at the price of $50 by 31/12/2020. Okay, so if this is not mandatory, this is not obligatory, they have a right, this is an option the CEO can use. Okay, so imagine like you are using your you are getting your salary monthly based, fixed, but this motivates the CEO to work harder to increase the stock price to maximum value possible. Okay, so if CEO can rise the stock price to, for example, $65, so he will get he or she anyway get $15 multiplied by 1,000 shares, which will be $15,000 at the end of the year. This is an extra for the CEO. So this motivates the CEO to work harder and improve the company and develop the company anyway. So this is the right. But that will be at the same time cost on the company. Okay? This is another cost on the company. So this should be recorded when the CEO exercises this option. But if he doesn't exercise this option and the stock price was only 50 or less, so the CEO will not exercise this option, and that cost will not incur for the company. Okay, so this should be recognized as a cost when it occurred. Okay, so here's the facts and details about what I just explained to you. The case is the same for interest costs also. So we know what's interest. It's extra cash paid for the money that we borrow. It's an expense. And interest rate, so determined by the risk characteristics of the borrowers, like default risk of the borrowers. Interest expenses are determined by interest, principal, and time. Anyway, so the payment of these interests depends on the bond that has been issued, and the most important thing here is to know that analysts view interest as a period cost, not capitalizable. Okay, like it's not forever and it's not fixed. This can be changed from a year to year, and those should be recognized as a costs and should be recognized when the actual cash is paid for these interests. Okay, so that was the end of the lecture, and there will be another video following this video to solve the problems in here. Okay, thanks for your attention, and there will be another video solving the exercises and problems for this chapter.